In the final section of profitability analysis, we come to the model of EVA, economic value added. It is also sometimes called economic profit. Now, to take you back, our topic was profitability. We have used margin analysis. We have used return analysis. Now we are using economic value added. EVA is a measure of how much value in dollar terms the company has created or destroyed. The EVA model involves comparing the return on invested capital to the cost of capital, or WACC, which stands for weighted average cost of capital. WACC reflects the investor's expectation. So for example, if we say weighted average cost of capital equals to 10%, for example, that means investors expect a rate of return equal to 10% on their money per year. Now, investors want to get 10% on their money per annum. Now we look at how much the company has produced as measured by the return on invested capital. For this company, PCP, we already calculated that ROIC was 3.52% for the year 2023. Its cost of capital, we assume WACC equals to 10%. Now, how do we do that? If you look at the current rate of the 30-year government bond in Thailand, it is 3.24%. Now, when we add that to the equity premium, we can safely say average cost of capital in Thailand is around 10%. So we shall assume that investors in Thailand expect to earn a rate of return of at least 10%. Now, as long as the company's profitability is equal to 10% or greater, that is good performance. If the company generates more than 10%, it means the company has created value for the shareholders, means extra profit. If the rate of return is lower than 10%, the company has destroyed value. So we take the difference between ROIC and WACC, and then we multiply. That is how much the company generated or destroyed in percentage. We multiply by the total capital. ROIC is 3.52%. WACC is 10%. If you take the difference, it's negative. You multiply by the total capital. ROIC is 3.52% for the year 2023, and the WACC or WACC, the cost of capital, 10%. The difference is 6.48% negative, because the cost of capital is greater than the ROIC. When you multiply that by the total capital, which was 241 billion, you get a negative, minus 15 billion, meaning in the year 2023, the company did not achieve its financial objective, which was to create value. Rather, the company has destroyed shareholder value. Destroyed in the sense that the company's profitability was much lower than the cost of capital or the rate of return required, expected by the shareholders. So we say this company was not successful in the year 2023 because it did not perform to the expectation of the shareholders.